Hall and Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello and welcome back to the latest season of Tax Records. My name is Adam Demack and I'm a special counsel in the tax team at Hall and Wilcox. I'm very happy to be joined today by my colleague and friend, Todd Bromwich, who is a senior associate in our tax team.
Thanks for having me along, Adam. Pleasure to be here as always.
Thanks, Todd. Today, we're going to discuss the proposed changes to Australia's tax residency rules for individuals. Everyone tuning in will no doubt either be familiar with the current rules or familiar with just how complex and problematic they can be. But just to get everyone on the same page, I might go through the rules quickly. An individual will be an Australian tax resident if they meet one of four tests. The first test is when someone is an Australian resident according to ordinary concepts. So this requires an evaluation of personal circumstances, taking into account a range of factors relevant to where someone usually resides or their usual residence. This might be where a person eats, sleeps, or keeps their house, as the courts have told us. The second test is when somebody is physically present in Australia for at least 183 days, unless they have a usual place of abode outside of Australia and no intention to take up residence in Australia. And that term, usual place of abode, has a lot of case law and history attached to it. The third test is when someone's domicile is in Australia, unless they have a permanent place of abode outside of Australia. And then the fourth test is for those people who are members of Australian government superannuation schemes or their spouse or minor child is a member of one of these schemes. Now, with that all in mind, Todd, what are your views on some of the issues or what might be wrong with these current tests?
Well, the main concern that's raised about these tests is the lack of certainty. As you just outlined, the rules are highly fact dependent. They can be quite complex depending on your circumstances. And so coming out of that, we're seeing the ATO regularly challenge taxpayers' self-assessment of their residency, and they're pursuing cases that are genuine 50-50 line ball cases. The outcome really could swing either way on the facts of the matter. This is not good for taxpayers because they need certainty in their tax affairs. It's not good for advisors who need to be able to confidently advise on these matters. And it's not good for the ATO either because their resources can be better directed elsewhere than running protracted tax residency disputes. So this led to a few years of review and consultation by the Board of Taxation from 2016 to 2019. And that culminated in a 2019 report by the board that proposed an overhaul of the individual tax residency rules. And the changes that are now being recommended by the Treasury, they've put out a consultation paper. Those proposed changes follow the Board of Taxation's recommendations.
Yeah, thanks. I think that those observations are pretty fair, and we've certainly been waiting for some time to see some proposed changes to the individual tax residency rules. So broadly speaking, what is Treasury proposing?
So Treasury is proposing a system in two halves. They're going to, unlike the current system, they're going to have one set of rules for determining whether and when an individual will commence as an Australian tax resident, and another set of rules for determining when an individual will cease to be an Australian tax resident. And there is some overlap in there as well. So in terms of commencing as an Australian tax resident, we'll have two primary tests. One is if you're a federal, state or territory government official deployed overseas, you will be an Australian tax resident for the duration of the deployment. The other primary test will be a simple, what we call a bright line test. So a person who is physically present in Australia for 183 days or more in an income year, and so that's 1 July to the following 30 June, will be an Australian tax resident for that year. Now, if you don't come within the primary tests, you then have to consider the secondary test. So under that test, under that secondary test, if you are physically present in Australia for 45 days or more in an income year and your circumstances include two relevant factors, you'll be an Australian tax resident. So there's four relevant factors, and just to briefly go over them, the first is you have right to reside permanently in Australia. Now that includes citizenship or a permanent residency visa. You have Australian family, and so that focuses on whether you have a spouse or a child under the age of 18 living in Australia on an ongoing basis at any time during the income year. The third is that you have a legal right or arrangement to access residential accommodation in Australia at any time during the income year. And the fourth and final factor is you have certain economic interests in Australia. Now, this is a bit broad, but it includes carrying out your employment duties in Australia, active participation in a business in Australia, or you have direct or indirect interests in Australian assets. Now, they include Australian land, an interest in an Australian trust, or an Australian bank account with significant cash deposits. And I suppose the upshot of these proposed changes is that if you are physically present in Australia for 45 days in an income year or more, there is a risk that you will be an Australian tax resident, and it's something that needs to be considered.
Understood. And in a general sense, do you see any issues with these proposed new rules?
I personally have no issues with the primary tests for government officials and people in Australia for at least 183 days a year. They're simple tests to apply, and I think they make sense. My concerns lie with the secondary tests for establishing residency. I think, first of all, that 45 days seems a bit too short to me. So 45 days was settled on by the Board of Taxation and Treasury as it's longer than Australia's normal annual leave period of 4 weeks. And because 2018 migration data showed that the median stay for visitors was 11 days. And finally, because most short-term visitors, according to that migration data, stayed in Australia for less than 60 days. I think this needs to be checked against current migration data. Things have changed quite a bit from 2018. It would be good to get a view of what those numbers look like now. But also, we can't really be applying Australia's annual leave standard of 4 weeks to all foreign persons in determining whether their trips to Australia are beyond what we'd usually consider a short-term stay. I'm not sure that our annual leave standards in Australia under our employment law really has a great deal of relevance to foreign individuals. And also, finally, that where they've focused on the fact that most short-term visitors to Australia stayed less than 60 days, it is just a little unclear how they've now wound that back to a 45-day period under the test.
Thanks. Those comments are pretty fair, and I think you're right. Relying on 2018 migration data probably seems a little bit ill-advised, given, I guess, the move towards sort of a globalization of workforces and people being able to work flexibly. And I have friends who are doing the same job that they've done for years in Australia, doing it from Southeast Asia or other places that they prefer to sort of be in. What do you think would be a better number than 45 days?
There's no magic bullet to this. There's no perfect number. I think no matter what number we settle on, there will always be people who are inadvertently caught by this. But I think a longer period, something like 60 days, possibly even 90 days, would make more sense. Like you were saying, it's easier now than ever to travel for longer periods of time overseas. And with remote work, it's possible for a lot of people to just continue their work uninterrupted while they're traveling. We're seeing a big uptick in work from anywhere policies with a lot of employers. So I think a longer period, perhaps 60 days, should be considered by Treasury.
Okay, thanks for that. Now, this is a bit of a big question, but could you go back to the secondary test and the 4 factors that you mentioned? Could you explain them for me?
Yeah, and I think that's my other issue with these proposed changes is that these factors make sense broadly. I don't see any major issues with them, but I think they do need to be refined when it comes to drafting these rules. So the Australian economic interest factor, this will, as I said, that'll capture anyone with a taxable Australian property interest, an interest in an Australian trust, a significant deposits in an Australian bank account. Now, capturing anyone with an interest in an Australian trust many of our listeners will know just how broadly a trust deed can be drafted. And many of us are likely potential general beneficiaries of a number of trusts we don't even know exist. So this should at least be limited to individuals that are specifically named in the trust deed or are a default beneficiary of the trust. And generally, they're the same people. It will be interesting to see what Treasury considers to be significant cash deposits also in an Australian bank account. They're going to have to peg that to a particular number. Will be interesting to see where they peg it and also whether that number will change over time. The next one is the Australian accommodation factor. I think that's too broad also. I can understand that individuals who own an Australian property that remains substantially vacant and can be used by them when they travel to Australia, it makes sense to me that should be quite a relevant factor in determining Australian residency. But at the moment, this factor is cast very broadly. It'll be met if the individual has a legal right to Australian residential accommodation at any time during the income year. Now, that could, as it's cast by Treasury, arguably apply to anyone who pays for short-term accommodation in Australia while they're travelling here. If I rent out a Cairns Airbnb for a week, that is Australian residential accommodation that I have a legal right to access. So there's some work to be done to refine that factor also. Finally, and probably a less significant point, the Australian family factor could potentially do with some tweaking. At the moment, it's cast so that the factor is only relevant if your spouse or children under the age of 18 are in Australia. But I think it should probably only capture children under the age of 18 who are dependent on the relevant individual taxpayer. So it doesn't account for situations of a split family where the individual coming to Australia is really not the primary carer for the child. I think it also shouldn't capture spouses where the Commissioner is satisfied that the marital relationship has broken down, but the couple is just not yet legally divorced. It's not uncommon for a couple to be separated for a large number of years and have no real interest in going through the actual legal process of getting divorced. They just see it as unnecessary.
Thanks for that, Todd. I mean, yeah, I agree with those comments that some of these factors are sort of far too broad. You know, for example, as you mentioned, the economic interest factor capturing anyone who is a general beneficiary of a trust is just enormously broad. And if that's a trust that was established when that person was an Australian tax resident, or if they have direct family members that are Australian tax residents, then it's almost going to be very likely in most situations that a direct family member will be a general beneficiary of that trust. I mean, sort of looking at it more broadly and generally, what do you think of these factors on an overall basis?
Yeah, I should just note that the Australian Trust one, Treasury, in fairness to them, they don't mention general beneficiaries, but they do talk about someone having an interest in an Australian trust. But, you know, the devil is in the detail here. We'll just have to wait till we see the actual drafting in the legislation. But I think that's going to be a tricky one to get some specific wording in the legislation to give everybody certainty as to what that actually means. But overall, these tests are intended, based on the consultation paper, they're intended to be based on measurable objective criteria. And so, as I said, we really need to see how these rules will be drafted, because based on what the Treasury has said in the consultation paper, there is a lot of room for movement in how these tests and these factors are expressed. And they may leave the door open to a lot of interpretation issues, which kind of just gets us back to the uncertainty that we're in at the moment.
Yeah, thanks, Todd. I mean, yeah, you're right. The devil will be in the detail. We'll have to look at how it's drafted. If Treasury is using the word interest in a trust, you wonder whether they might tie it into where that language is used already. For example, CGT event E4, which refers to an interest in a trust, but then that would potentially exclude all mere objects of a discretionary trust. But anyway, let's move on from that. I think you explained before that this is sort of a system of two halves. What are the tests that need to be considered for ceasing Australian tax residency?
So if an individual determines that they are an Australian tax resident in an income year, the following year, each subsequent income year, they need to consider whether they have ceased to be an Australian tax resident under the ceasing residency tests. You can cease to be an Australian tax resident in three ways under these proposed new measures. One will apply to short-term residents, so individuals who have been an Australian tax resident for less than 3 consecutive income years. And the other two will apply to long-term residents. So you've been an Australian tax resident for 3 or more consecutive income years. So the first test for ceasing short-term residency is you'll cease to be an Australian tax resident if you've spent less than 45 days in Australia during the income year and you satisfy less than 2 of the 4 factors that we just discussed earlier. Uh, if that occurs, you'll cease to be an Australian tax resident from the day after you left Australia.
Okay, so this is where the relevance of that 45-day period comes into play. So if you're in Australia less than 45 days and you display one of those factors we went through, being either a right to reside permanently in Australia, close Australian family, a legal right or arrangement to access Australian accommodation, and an Australian economic interest, you'll cease to be a resident.
Yeah, that's right. And I suppose the 45 days here, the Treasury has proposed to just set the same number of days for that secondary commencing residency test and also for the ceasing residency test. I'm not quite sure of the rationale for that other than just keeping things simple. But the rationale that they've included in the consultation paper around the 45 days really focuses more on why it's relevant and an appropriate number on the commencing residency side. And some of those comments about, Australian annual leave periods, inbound migration data doesn't really have much relevancy to the question of an outbound migrant. The other 2 tests, as I said, will only apply to individuals who have been a resident of Australia for 3 or more consecutive income years, which are referred to as long-term residents. And the first one is the overseas employment rule. So this test is designed to allow long-term residents to immediately cease Australian tax residency where certain conditions are met, including in relation to their employment. So this test will be met if you leave Australia to take up overseas employment, either with your current employer on a deployment or with a new employer overseas for a period of at least 2 years, and you have accommodation available to you for the entire employment period overseas, and you spend less than 45 days in Australia in each income year of the employment period. Now, again, if that test is met, you'll cease to be an Australian tax resident from the day after you left Australia.
All right, thanks. I think your earlier comments there about using the same 45-day period for commencing and ceasing residency tests is an interesting one, because you would expect that someone ceasing residency, so someone who's already been an Australian tax resident for some period of time, would probably be spending far more time in Australia. More likely to spend more than 45 days in Australia. So that's a pretty astute observation. In terms of what you just mentioned, though, that's also interesting, because it seems like some of these factors will need to be met over the entire period of employment, but the individual ceases residency from the day they depart Australia. Potentially a bit of a mismatch. So what happens if someone's sort of circumstances change, within that 2-year period or something like that?
Well, Treasury is proposing 2 things. First, the individual will need to notify the ATO if they're electing to apply the overseas employment rule. Presumably, that'll be via their tax return when they tick the box to say they will no longer be an Australian resident. So the ATO has greater visibility on this. And if the individual is subsequently found to not meet the conditions of this test, so not meet the conditions over that entire test period, they'll be deemed to have never ceased to be an Australian tax resident. So there's a bit of a nasty sting in the tail with this one, where they might need to unwind a couple of years of tax lodgements. There could be penalties, interest charges. It's a bit of a nasty one where the change in their circumstances might not have been reasonably foreseeable when they've moved overseas, and they might have been acting with the best intentions at that point in time. Treasury is also proposing an additional integrity rule to deny access to this test where the employer is an associate of the individual. And that's intended to prevent individuals from gaming the system by, if they have a foreign trust and they want to flush money out of it without attracting the operation of Section 99B, they want to change residency overseas, they can't just get one of the entities in their family group that sits in an overseas country to give them employment for a couple of years so that they can do that. I can understand the rationale for that, and that's to prevent bad actors from gaming the system, but that will make it tough for individuals who are genuinely employed in family groups with cross-border operations that might require them to move overseas for a period of time to build or grow or just oversee those overseas operations. They'll be cut out of this test effectively.
Yeah, I mean, talk about sticky or adhesive residency. It really is a bit of a sting in the tail if somebody's circumstances change. Trying to predict 2 years ahead of time of your life is probably going to be pretty difficult. And these associate rules, I think I agree. I totally understand why they're there, but you would imagine that maybe our existing anti-avoidance rules would probably capture those sort of arrangements anyway. I think we haven't yet gone through a final test for ceasing tax residency. Is there one more?
Yeah, so that's ceasing long-term residency. So again, if you're a long-term resident and you don't meet that overseas employment test, you'll look to this last test, which takes a bit longer to satisfy. So this test will be satisfied if you've spent less than 45 days in Australia for 3 consecutive income years. Now, if that test is met, you'll cease to be an Australian tax resident from the start of from the 3rd consecutive year. But those first 2 years, you will have still been an Australian tax resident.
So under this test, your residency only changes in that 3rd year. So, like you said, the first 2 years, still a tax resident.
Yeah, that's exactly right, Adam.
All right. So, the Board of Tax Report and the Treasury consultation paper, they say that these new rules need to be consistent with 4 principles. One, we spoke about a bit, adhesive residency. The other is certainty. The other, simplicity. And then the final one, integrity. How do you think what's being proposed measures up with these 4 principles?
Well, as you said before, the proposed new rules definitely meet the principle of adhesive residency. These rules will make it easier to commence and harder to cease as an Australian tax resident, quite hard in both circumstances. I think these rules will clearly capture more people as Australian residents. They will drag more people in and will make it harder to escape. So one practical outcome of this is that we'll probably see more individuals that are tax residents of multiple countries under each country's domestic tax laws.
Yeah, I think you are probably right. And so if that's the case, and we have more people who in this, global world of, travel and working remotely, working flexibly, if we do have more people who are going to be captured as Australian tax residents, but they're also tax residents in another country, what does it mean for them practically?
Well, I think this will probably lead to a greater focus on 2 things. The first is Australia's international tax treaties, which contain residency tiebreaker rules. Now, those rules are designed to ensure that dual tax residents are deemed to only be a tax resident in one of those countries. Now, this will be a steep learning curve for some practitioners who are not too familiar with these treaties and how to interpret them, because otherwise they just may not have applied to some of their clients. The issue with this is that the tax treaties can require some of the factually dense analysis that we have to go through under the current rules. So, for example, if an individual is a tax resident of Australia and the UK, our tax treaty with the UK says, well, they're deemed to be a resident only in the country in which a permanent home is available to them. And that doesn't have to be one that they actually own. That can be long-term rental. But if a permanent home is available to them in both countries, for example, they own a house in Australia, but they rent long-term in the UK or vice versa, or they have a permanent home available in neither country, well, they're deemed to be a resident only of the country in which their personal and economic relations are closer, and that's known as their centre of vital interests. Or consider the tax treaty with the USA, which requires us to consider where the individual maintains their permanent home. Or in both cases, the question of where their centre of vital interests is or where their permanent home is, that requires a close analysis of their personal circumstances. And that really detracts from the certainty that Treasury is trying to establish in these rules. It kind of just gets us back to square one.
Yeah, I mean, I think you're right in terms of simplicity and certainty. It's sort of out of the frying pan and into the fire once you're sort of leaping into some of the DTAs. So I suppose the next step then would be to try and modernize these, tiebreaker rules in the DTAs and the tax treaties.
Yeah, I agree. Although that is a very slow process, so I wouldn't hold your breath for those changes to come through anytime soon, if they're planned at all. Of course, not every country has a tax treaty with Australia. Individuals that are dual residents of Australia and one of these countries that doesn't have a tax treaty with us, you'll just instead need to rely on the second item I was going to get to, which is Australia's foreign income tax offset rules. So where an individual is taxed in two countries on the same item of income, they should be entitled to a tax offset in one or both countries to minimise or negate the double taxation. So being a dual tax resident is not always the world-ending scenario that many might believe, although there are limits to what might be claimed under these rules, and it does add a bit of complexity to your tax affairs, lodging in two different countries, trying to figure out the tax offset rules in both. There's timing issues that need to be considered and which jurisdiction tries to have the first bite of the cherry. So it is an undesirable outcome, and it's better if your clients can get to a position where they're tax residents of just one country.
Yeah, I think you're right. And in terms of waiting for modernization of these tiebreaker rules in the tax treaties, I mean, we waited several years to see this consultation paper on our own internal residency rules. So I don't imagine a modernization of the tiebreaker rules will be coming along anytime soon. One other thing I wanted to ask you about was whether there are broader implications from all of this, and specifically implications for entities like trusts and companies. So you might imagine a scenario where someone is captured under these new rules and they're deemed to be an Australian resident for tax purposes, and that person is, for example, the trustee of a discretionary trust. So can these rules have sort of broader impact than just impacting individuals?
Yeah, that's right. The implications of these changes go beyond just individual tax residency, and they can extend to if an individual becomes an Australian tax resident, that can, in certain circumstances, trigger a change in residency for some of their related entities. So one way to mitigate this risk for trusts is to consider whether it's appropriate to have a corporate trustee rather than individual trustees of the trusts. Whether that's appropriate will really depend on all of their circumstances and those of the trusts, and the requirements and implications of this in the foreign jurisdiction. So it's really important that if you are going to make a recommendation like that, that their client seeks complementary tax advice in that foreign jurisdiction. And it's trusts and companies as well. Companies can become Australian tax residents in certain circumstances. It's a bit harder than trusts, where all you need is an Australian trustee, but it is still a risk to be considered. So, including a foreign company as trustee of a trust isn't really a foolproof measure, and it's not necessarily the case that a foreign company will always be a foreign tax resident. So they're just a couple of things to keep your mind on when people are thinking about these proposed changes to the tax residency rules. They are broader than you would originally think.
Thanks for that, Todd. It's been a great discussion today, and I'm not our expert presenter today, but my view is that while it's welcome to see proposals to update and change our individual tax residency rules, it seems like these rules aren't going to be all that simple, and for the average Australian and the average Australian individual taxpayer, they're still not going to be rules that they can necessarily navigate on their own, and they're likely to need to come to see a tax professional for some advice.
Yeah, that's right. I agree. It's great to see that changes are coming in, and I definitely don't want to, be overly negative about tax reform because it's needed in a handful of areas, not just tax residency. But hopefully Treasury will take a pragmatic approach to some of these measures and, consider some of the submissions from professional bodies and from the public around the practical implications of how they're currently casting these rules and how they can minimise any unintended outcomes.
Yep, I wholeheartedly agree. Anyway, I think that's enough from us today. Probably ready to wrap things up. I'd like to thank everyone for listening to this episode of Tax Records. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hallandwilcox.com.au, or you can connect with us on LinkedIn, or if you know either Todd or I, you can reach out to us personally. If you enjoyed today's episode, then please rate, review, and follow our podcast wherever you do get your podcast from. And please enjoy the rest of your morning, afternoon, or evening.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.